job. Fuck that, yeah, speak, Eric, let me do my job.
Avatar wants your bid for 200.
Welcome to our deep dive into the world of algorithmic trading. In this video, we'll explore two powerful tools traders use to gain an edge in the financial markets: time series analysis and machine learning. These techniques help traders understand past market data, forecast future price movements, and develop smarter trading strategies. By the end, you'll have a solid grasp of how these tools work and how they can be applied in trading. Time series analysis overview. Let's start with time series analysis, a key technique in trading. Time series data is essentially any data collected or recorded at regular intervals over time. In trading, this data could be prices, trading volumes, or other market indicators. The goal of time series analysis is to identify patterns, trends, and relationships within the data, helping traders predict future movements. There are three main concepts to focus on here. 1. Trend, the general direction the market is moving in over the long term. 2. Seasonality, regular, repeating patterns that happen at specific intervals, like monthly or quarterly cycles. 3. Noise, random variations in the data that don't represent any clear pattern or trend. Understanding these components helps traders make more informed decisions based on the market's historical behavior. Number 1. Decomposing time series data. Breaking down time series data can give us a clearer picture of the market's underlying structure. There are three key components to consider. 1. Trend component. This shows the long-term movement of the data. It helps traders understand the overall market direction, whether it's up, down, or neutral. 2. Seasonal component. This captures periodic fluctuations in the data. For example, certain sectors might perform better during specific times of the year, like an increase in retail sales before the holiday season. 3. Residual component. After removing trends and seasonality, we're left with the residual, which includes noise and random fluctuations. While it might seem insignificant, understanding the noise can help you spot anomalies or unusual market behavior. Number 2. Popular time series models. Time series analysis involves a number of statistical models, which can be applied depending on the data. Some of the most commonly used are autoregressive, AR, models. These models predict future values based on past observations. The idea is that past behavior can give us clues about the future. Moving average, MA models. These models smooth out the short-term fluctuations in the data to better see the longer-term trends. ARIMA models. Combining both AR and MA models, ARIMA is a powerful tool that handles non-stationary data, which is common in financial markets. SARIMA models. These add a seasonal component to ARIMA models, making them perfect for data with clear seasonal cycles. These models help traders forecast price movements and identify trading opportunities based on historical data trends. Number 3. Advanced time series techniques. For more advanced trading applications, there are several techniques that go beyond basic models. GARCH models. These are used to estimate and forecast market volatility. Understanding volatility is crucial for risk management, as it tells you how much a market might fluctuate in the near future. Cointegration and error correction models. These are useful for analyzing long-term relationships between different assets. They help traders understand how different markets or stocks move together over time. State space models. These models use latent or hidden variables to represent time series data, making them flexible enough to handle non-linear or non-stationary series, which is often the case in real-world trading. These techniques can help traders better understand the complexity of market data and refine their strategies. Number 4. Practical applications in trading. So, how can we apply time series analysis in real trading scenarios? Here are a few key ways. 1. Forecasting prices. By applying time series models to historical data, traders can make educated guesses about future prices. This allows them to make smarter decisions about when to buy or sell. 2. Identifying trends and patterns. Time series analysis helps traders spot trends and patterns that might not be obvious at first glance. This can lead to the development of trading signals and strategies. 3. Volatility. Forecasting. Understanding and predicting volatility is essential for risk management. Models like GARCH are designed specifically to forecast market volatility, helping traders prepare for sudden price swings. 4. Algorithm development. Time series analysis is the foundation for developing algorithmic trading strategies. These algorithms can execute trades automatically based on the patterns and trends identified in the data. Number 5. Machine learning and algorithmic trading. Now let's move into machine learning, another powerful tool in algorithmic trading. Machine learning, or ML, has transformed how traders analyze complex data sets, uncover patterns, and optimize strategies. Machine learning models learn from data, making them particularly good at finding relationships that traditional statistical models might miss. Let's break down the key ML techniques in trading. Supervised learning. In supervised learning, models are trained using labeled historical data. This means the model learns from data where the outcome is already known, like whether a trade was profitable or not. The goal is to predict future outcomes based on this learning. Some common supervised learning algorithms include linear regression. This predicts the relationship between a dependent variable, like asset prices, and independent variables, like technical indicators. Decision trees. These help identify the most significant variables affecting trading decisions, breaking them down into a tree-like structure of decision rules. Support vector machines, SVMs. These classify market conditions, grouping data into categories like bullish, bearish, or neutral. Neural networks. Neural networks are especially good at capturing complex, nonlinear relationships in large data sets, making them highly effective in predicting market trends. Unsupervised learning. Unsupervised learning is different. It doesn't require labeled data. Instead, the model looks for hidden patterns or groupings without predefined outcomes. This is useful for exploratory data analysis. Some common unsupervised learning algorithms include clustering. Techniques like K-means clustering groups similar data points together. In trading, this can help identify market regimes or classify assets based on similar behavior. Principal component analysis, PCA. PCA is useful for simplifying complex data sets, reducing the number of features while keeping the most important information intact. Anomaly detection. This detects unusual patterns in the data. In trading, anomaly detection can signal potential opportunities or alert traders to abnormal market behavior. Reinforcement learning. Reinforcement learning, RL, is a different beast altogether. In RL, models learn by interacting with an environment, in this case, the financial markets. The model receives rewards or penalties based on its actions and gradually learns to make better decisions over time. Key RL concepts include agents and environments. The agent is the trading algorithm that makes decisions based on interactions with the market. Environment. Policy and value functions. The policy guides the agent's actions, while the value function estimates the expected rewards for different actions. Q-learning. Q-learning is a popular RL algorithm that improves trading strategies by learning from past actions and rewards. Advantages of machine learning in trading. Machine learning offers several benefits in trading. 1. Handling complex data. ML excels at processing large data sets with multiple features, finding relationships that traditional methods might miss. 2. Adaptability. ML models can continuously learn from new data, adapting to changing market conditions. 3. Automation. Machine learning automates pattern recognition and trade execution, reducing the need for human intervention. 4. Enhanced predictive power. ML models improve predictive accuracy, providing more reliable forecasts and insights. Number 6. Bayesian methods in trading. Key concepts and applications. Bayesian methods provide a powerful framework for making data-driven decisions in trading by combining prior beliefs with new data to update probabilities. At the core of this approach is Bayesian inference, which allows traders to update their understanding of market conditions as more data becomes available. The main formula is P theta D, Chuck P D Th P Th, PD. Here, the posterior probability, P theta D, represents the updated belief about a parameter, Th, after observing the data, D, incorporating both the prior probability, P Th, and the likelihood of the data, PDT. Core concepts. 1. Prior distribution. Represents initial beliefs about a parameter before seeing data, reflecting assumptions or historical knowledge. 2. Likelihood function. Describes how likely the observed data is given different parameter values, showing how well the model fits the data. 3. Posterior distribution. Combines prior and likelihood to give an updated probability distribution for the parameter after considering new data. Applications in trading. 1. Parameter. Estimation. Bayesian methods help refine model parameters, such as in a moving average model. by updating estimates with new market data. 2. Model selection. Bayesian model selection evaluates multiple trading models based on posterior probabilities, aiding in choosing the most appropriate strategy. 3. Risk management. Bayesian approaches offer probabilistic assessments of future market conditions, helping traders manage risks like potential losses and gains. 4. Forecasting. Bayesian forecasting predicts market movements by generating a range of possible outcomes and their associated probabilities. Practical tools. 1. Bayesian networks. Graphical models that show probabilistic relationships between market variables, aiding in understanding dependencies like those between economic indicators and asset prices. 2. Monte Carlo methods, used to estimate complex probability distributions by simulating many random samples, helping to assess trading strategy outcomes. 3. Bayesian optimization. Optimizes trading algorithms by refining parameters based on performance metrics such as returns. Despite their advantages, Bayesian methods can be computationally complex and require careful selection of prior distributions and high-quality data for accurate results. Conclusion. Algorithmic trading is evolving rapidly, and tools like time series analysis, machine learning, and Bayesian methods are becoming essential for gaining an edge in the financial markets. These techniques help traders make more informed decisions, optimize strategies, and adapt to changing market conditions. By understanding and applying these powerful tools, traders can enhance their ability to forecast prices, manage risk, and automate trading processes, ultimately leading to more efficient and profitable trading strategies. Thank you for joining us, and we hope this exploration has shed light on how these advanced techniques can be integrated into your trading approach.